Okay, thanks so much for tuning in to this conversation. The whole idea of this conversation with Probal Sen of Centrum Broking is to try and do a bit of sky gazing, that if indeed crude were to move up to slightly higher levels, what would the impact be on certain specific pockets within the oil and gas space? Now, technology plays its tricks, and I don't know if we still have Probal Sen with us or no, because he was with us just a minute ago and then he got disconnected. Okay, I think he's still with us. But as I say, as
Yes.
I was saying, Probal, you are with us. Okay, great. So, Probal, the whole idea of why we thought of calling you was that there are a bunch of these calls that have come in, right? Chris Wood in his Greed and Fear report says, why can't oil go to 95? Goldman, Morgan Stanley, all of them are upgrading the forecasts. So, I mean, with an assumption that oil stays here or goes higher, we thought let's try and get a sense of what the impact could be on the earnings of some of the impacted pockets and start off with the upstream companies. By the way, just before we get underway, do you have a view on crude at all or no?
So I think my internet connectivity seems to be a bit spotty from what I can tell. I got a little bit. Please tell me if you can hear me, Ram.
We can hear you loud and clear, Probal.
All right. So if I could understand you, you were talking about the forecasts for crude, obviously moving up from everyone,
And
and
the
far,
impact.
you know, yeah. I mean, so there are two sides to it, and we have seen this before that with crude, whenever this kind of a sudden movement happens, the forecasts across the street tend to sort of start building in extremely aggressive estimates. And this is something that we have seen earlier when crude reached $140 in the aftermath of the financial crisis. You would remember that there were forecasts of $200 a barrel being hit anytime soon, and then we know what has happened after that. If I look at it this time around, assuming that the forecasts are true, then obviously I think ONGC will be, a big beneficiary from an earnings perspective. Every $5 movement in crude prices tends to bump up its annualized EPS by upwards of 4 to 5 rupees a share, which on the current base, yeah, I mean that seems about right. My forecast suggests a 4 rupee movement, but that's roughly what the numbers are. And obviously, given the base that they are working with on a standalone level, that's a 30 to 40% bump up in annualized EPS estimates. So obviously, I think that's something that uh, is a significant move up. What is going to be interesting, however, to see is that this time around the crude increase is almost entirely being driven uh, to if you look at it, it's almost entirely being driven by. Let me clarify that these are standalone numbers. These do not factor in
Yeah, yeah.
the contribution
Probal,
of OVL, HPCL, and so on.
Probal, we'll come to the financials in a bit. First you very comfortably make your
Uh-huh.
points, and then we'll come to the financials. No problem.
Uh-huh. Mhm. So yeah, I mean, my broader perspective is that this increase has been led almost entirely by supply changes, right? I mean, supply disruptions, managed supply cuts across the board by OPEC plus Russia, and as of now, on the ground, demand has still not really recovered to the level that would justify a price of $62 to $65. That's very clear. And I think that is what you highlighted a comment on for from Mr. Chris Wood, where he's saying that if the economy were to reopen completely, and that assumes, however, that when the economy recovers and demand comes back, the supply continues to remain this constrained for an extended period of time. We are talking about annualized estimates. Let's not mistake the weather patterns that are there in Texas and the 4 million barrels of capacity that's got shut in addition to the 2 to 3 million barrels that still remains off the market from OPEC and its members plus Russia. That the assumption that one demand actually normalizes, supply will continue to be constrained, and people will be comfortable letting the price go to 70 $75 in an economy which is probably a year away from anything resembling normalcy across the globe.
Mm,
I think that's
mm.
probably too pessimistic a way to look at the reactions of suppliers. And also, it assumes, I'm now honestly, I have no idea how long it will take to restore the oil supply coming in from Texas. Let me qualify that. I think nobody really knows how long it will take for the shut in capacity to completely come back. But we have seen the US industry responding extremely quickly in the past to improvement in operating conditions. So I would be a bit more optimistic about the supply coming back and therefore crude continuing to trade in a range of 60 to 65 or even 55 to 65 in the near term, rather than being completely bullish and saying 70, 75 is the new normal. I really don't think that the state of the global economy supports that kind of pricing. Or let me put it another way, if price sustains at $70 for any period of time, I think you are likely to see a significant demand cutback on top of what is already a very weak demand environment, where we have
Mm,
seen that from annualized levels of 1.1 to 1.2 million barrels a day, we are now staring at maybe less than zero point 0.7, zero point 0.8 million barrels being the new normal in terms of demand addition on an annualized basis globally. So
wow.
that's the broad, I think, sense I get, that 70 $75 will be a difficult sustainable price. It may reach there. I have no idea what the prices are going to be like, but it looks difficult for it to stay there for extended period of time.
Yeah. Well, that's an important qualification. And by the way, Probal, I'm glad you're wearing a mask, because what you're doing in office is something that everybody should be doing outdoors and people are not. So I'm glad you're doing that. It serves a statement. But let's get back to the topic. And my question to you, therefore, would be that as somebody who is looking at the equity side of the equity companies which get impacted by crude, and let's focus for now on the upstream companies, that if 70 to 75, according to you, and maybe your message to your
Mhm.
set of large institutional investors also, they also believing it, is not a new normal, then how do you account for it in your estimates and your multiples for upstream companies, and the sentiment thereof for ONGC, Oil India, and some of the other explorer?
Well, I think ONGC has to first start reflecting a $45 crude price. Forget about $70. If you
Can you
look at
explain
the
that?
way that in the sense that if you look at the multiples that are there with respect to extremely conservative earnings multiple also, which are there in terms of my numbers, where we assume just a $50 deck for FY22 in our estimates. Even on that, if you are making standalone earnings of around 11 rupees and you have contribution of not less than 5 to 6 rupees at the very least from the likes of uh, OVL, MRPL, HPCL, and so on, then obviously the current price doesn't anywhere, justify anywhere close to what even the past prices have been. So for us to start, as I mentioned, that on this 10.5 rupees, if you remove, let's say, dividend income from these invested companies, if you want to look at them on earnings multiple, maybe around 60 paisa. So 10 to 11 rupees of base earnings on a $50 deck, with very limited production growth being factored into these numbers, plus 6 to 7 rupees, as I said, from the investments that they have. You're talking about a stock price of 110 rupees, which is like what, five, 6 times 1 year forward earnings. So very clearly, the concerns around ONGC extend far beyond what price realizations will be there, at least in the near term. So yes, I mean, at $70, the standalone earning itself, without doing anything, probably jumps to 17 or 18 rupees. So even at these multiples, that's a clear 50 rupee uptick. Even if you assume that the multiple remains the same, only the earnings get upgraded. That itself gets you to 160, 170 rupees a share. So there's a huge amount of upside. I mean, without a doubt, that can come through in these numbers and these multiples. But the concern around ONGC has been slightly wider. I mean, you would know that it's more to do with the fact, number one, oil production growth has now been declining possibly for the last 5 years straight. Instead of even being flat, it has actually shown a decline, where it seems like the older fields decline is now no longer being offset by whatever limited production gains are happening on the newer fields. This is despite, mind you, spending close to 30,000 crore a year on capex. So as long as that concern outweighs the clear benefits on numbers, I'm not too sure whether multiples can expand. And that has been our biggest worry about ONGC or Oil India for that matter. The one critical monitorable over the next 6 to 12 months has to be what happens on the KG basin execution. if the gas production starts by May, as has been guided in the latest quarterly update, I think that will be a fantastic positive, because the pricing for that gas is also slightly more than the less than break even price they unfortunately get for the rest of their gas portfolio. And that is the other part of it, that 45% of their output, which is natural gas, is actually sold today at 2.3 $2.4, which is less than their break even F&D cost. Makes no sense that an upstream company is forced to do this, but that's the regime we are with. That there is a theoretical formula which is based on gas surplus countries' prices, except for NBP. The other three are US Henry Hub, Canada, Alberta, and Russia domestic prices. These are all gas surplus countries, and therefore their prices are never going to be remunerative enough for a gas deficit country like ours. And so you bring it all together. What I'm trying to say is that if the crude is at $70, ONGC stock price should be at the very least 50% higher than what it is right now. But I don't know how to account for the concerns around core oil production, or the worries that are there about the gas realizations and the profitability of the gas segment. That's broadly it in a nutshell.
No, and that kind of explains everything. Maybe I can just ask a couple of small questions, Probal. And one of them is, would you therefore reckon that because some of these irritants are not going away in a hurry, that even if crude prices were to inch up, the smart institutional investor will not really make a beeline for an ONGC or an All India. They will take their time, and therefore the stocks will not really run away in a hurry. Would that be a fair assumption?
Well, I think what you've got to look at is over the last month or so, crude has gone up from about $50 levels to 60 to $62 levels, and we have seen some reaction from the stocks. It's not as if they've not reacted, but obviously the reaction is, as I just told you, the numbers. The reaction is nowhere near what you would expect. So I suspect that concerns around operational improvement, the leverage that now exists even on the standalone books, and the increased capital requirement, which would mean that leverage can only continue to go up over the next year, irrespective of, because the cash flows simply do not, the operating cash flows no longer cover your even your standalone or group capex requirements. Because of that, I think perhaps the upside will be naturally capped at maybe another 10-15% upside from here. That would be my considered guess. I have no idea, as I said. If crude goes to 70, as I again just said, there can probably be another move up, because then the momentum will be seen in crude prices. But maybe investors are also like me, waiting to watch and see how long does the weather anomalies in the US last, and when do they actually have some visibility of when this shut in US production is coming back. I think those are the two factors that people will perhaps take a look at, and then decide on their investment options for ONGC from these levels.
Got it. So, oil explorers, viewers, by and large, you got a brief sense from Probal about the pulls and pressures behind these. Now, Probal, a couple of other questions. If we can talk beyond the upstreams,
Mm-hmm.
what about the oil marketing names? Simply because it's not just oil which will be a factor for them. We already 100 rupees to a till on fuel. So I don't know how much more can it go up from here any which ways. But my
Mm-hmm.
question is that there's this whole divestment agenda. There's a webinar today, and BPCL has gone out and spoken about the Numaligarh transaction, so to say, or the expression of interest thereof. How do all of these stack up from both sentiment as well as just the overall traction that this space can demand?
No, so I think nobody buys. If you're a foreign institutional investor, I have often heard this earlier. That, am I audible? Hello.
Loud and clear,
Yeah.
Probal.
Okay. Sorry. My connection is a bit spotty, so
It's
that's
okay.
why
It's
I'm
okay.
asking.
Please
Um,
carry on.
so for the OMCs, number one is that the refining business obviously is seeing fairly weak trends. We have seen that for the OMCs. We have seen that for even Reliance, for that matter. That the downstream environment, and I was just referring to that when I spoke about the weak demand trends in the broader crude markets, which is obviously a function of what is happening on the FEND refined product market, and that is fairly weak. So therefore, there is not much excitement one can expect, at least from a refining standpoint, and the current multiples I think reflect that. But from a marketing standpoint, I would disagree with you a little bit, with due respect, with whether 100 rupees is the most that an Indian consumer can pay. I think, frankly, if one had asked this question when petrol and diesel were at 80 rupees, we would have probably had the same opinion, that it can't go much higher than this. But I think the fact that it is gradually happening suggests that there is a tolerance to these prices that is built in, or maybe there is a resignation to these prices. And that is good news for the OMCs because that pricing power has not gone away, even with crude rising. We have seen marketing margins, in fact, with a lag, catch up and go beyond 4 rupees, even factoring in crude prices of $60. So while every dollar increase necessitates a price increase of somewhere around 35 to 41 paisa a liter to maintain margins at this level, who is to say that, let's say $5, $65 average deck, they can't pass on another 2.5 rupees even on these levels. So I wouldn't take a bet on marketing margins compressing. And as long as that doesn't happen, what we are also seeing is that fuel consumption is coming back even at these prices at a reasonable level to pre-COVID levels, except for ATF, which is not exactly in the OMC's hands till aviation comes back in full tilt. Except for ATF, however, every other fuel does seem to be recovering at a gradual pace. So I would be a very comfortable buyer, particularly of HP and BP. IOCL, I always get a bit wary on because they've got too many moving parts. They've got these Northeast refineries on which margins are especially weak, except for the excise protection part of it. And they've got a petchem business which tends to be a bit volatile compared to some of the other businesses. But HP and BP, barring any huge negative surprises in the divestment process, and that doesn't seem to be the case, at least as of now. I think one would be very comfortably a buyer, even at these levels.
Very interesting, and thanks for that view as well, Probal. Can I just wrap up this conversation with one last conversation on the non OMC, non upstream names, and gas seems to be the buzzword. I don't know what kind of coverage you have there. I saw your note, and you do have some coverage. But for example, when I see Dharmendra Pradhan's tweets yesterday or day before, wherein he's talking about a northeast area as well coming into proper consideration, the capex being done there, the expansion, so on and so forth. And the demand at Morbi and for the export, and therefore the higher heightened demand for gas, maybe gas under GST, all of that. How does this stack up? Or this pocket as an investment theme?
So, my background has been from the gas space. I started my career with Gujarat Gas, so I always have had a little bit of a bias towards the CGD names and the CGD sector per se. I think I've always, over the last 3 years, continued to push this as
Wow.
a sector which will continue to outperform the broader markets. Gujarat Gas, for example, we have been positive from the time the stock was at 150, 160 rupee levels, just to give some context. So from
Yeah.
that sense, I think one has always been very positive about the state of the gas demand from the time really that the government took two decisions, one changing the domestic gas price formula. I just mentioned how it is extremely unfair to ONGC, but it ends up being one of the biggest margin drivers for the CGDs and has been for the last 3 years from the time that the formula got tweaked in favor of these gas surplus countries. I mean, obviously the pricing power of the CGDs in the CNG and domestic segment has just gone up tremendously, and they have made good use of it. The second factor that's also worked is that even in the spot LNG markets, and this is perhaps more specific to Gujarat Gas, even there the kind of supply surplus that one has seen, leave aside the last 2 month movement that was out of the blue in the last decade, but barring that, one has consistently seen that even the spot LNG price has continued to get more and more comfortable. And you mentioned Morbi. In Morbi, of course, there was some regulatory support also, where all the petco gasifiers got mandatorily banned as an alternate fuel, and therefore there's only LPG, which is the viable alternative for ceramic players. And LPG, we have seen in recent past that prices have started to recover sharply, and therefore even their pricing power has consistently been going up. So it's a combination of expansion in demand because of obviously the higher price differential that's opened up between CNG and petrol diesel. Higher regulatory support consistently, every regulatory measure on the margin seems to be supporting. IGL saw its commercial and industrial volumes start to expand once petcoke and other liquid fuels started getting banned from the entire NCR region. And similarly, Gujarat Gas saw similar pressure in Morbi. We would expect some sort of measures in Bombay as well, hopefully, sometime. That will be an added fillip for MGL's volume, for example. And thirdly, the margin profile has continued to improve, as I said, because LNG prices have been moderate, domestic gas prices continue to be extremely comfortable. And lastly, you just mentioned about the oil minister talking about the eastern part of the country. Gail did mention that volumes have started to flow from there. They are on track to complete the Jagdishpur, Haldia, Dhamra, Bokaro pipeline in various phases over the next couple of years. So, and that plus the fact that, even domestic volumes after a long hiatus, you would expect around 25 to 30 MMSCMD of additional domestic volumes. They would be at a slightly higher price than your traditional APM. Ideally speaking, if you look at the kind of price ceiling for those premium gas fields, but then even at $5.5 to $6, they will still be extremely comfortable compared to international prices. So that combined with the government push, we remain extremely bullish on the prospects of CGDs as well as GAIL and Petronet LNG for that matter. So yeah, I mean that's broadly what we think.
Great. Probal, thank you so much for taking the time out and speaking to us. Really appreciate you giving us some of the nuances around the upstream companies mainly, which is what we wanted to talk to you about, but the allied pieces as well, which apparently seem a lot more favorable from an investing perspective.
Thank you very much for having me. Thanks. This is quite a new way of interacting, so this was quite interesting.
Yeah, this was fun. Thank you so much, Probal. Thank you. And viewers, thanks for tuning in. I hope this gave you some insights into how to look at the oil and gas space in the wake of all the noise around crude prices inching higher and probably going all the way to $70 or $75. Even if that were to happen, maybe, just maybe, the gains may not be proportionate to what they should be in a normal scenario for the upstream companies.